If you've heard of Benjamin Graham, then I'm sure you've heard of the term margin of safety. Yes, it sounds like a traffic rule, but essentially, and as Graham explains it in The Intelligent Investor, it's the principle of buying a security at a significant discount to its intrinsic value. Now, what is intrinsic value is a larger question in itself, but to put it differently, think of the margin of safety like an inbuilt cushion which allows for some losses but prevents a major negative effect. For example, say you have an interview at 3 o'clock and your house is 30 minutes away. Now, prudence has it that you should leave your house a little before 2:30, say at 2:15, just in case there is some minor traffic disturbance on the way. That 15-minute buffer, that same margin of safety in an investing framework, offers investors a little elasticity against adverse developments which might happen due to external and internal factors like overpaying for a company, not assessing the risks properly, managerial incompetence, or being too optimistic with growth numbers, etc. It's the calculation part that everyone struggles with, and so in this video I shall present 3 different ways of computing margin of safety. And because I'll be presenting 3 methods, I also have 3 requests for you. 1, please do subscribe to my channel in case you have not done it yet. 2, if you find the video useful, then do like this video as it helps me with the YouTube algorithm. And thirdly, it will be wonderful if you can share your thoughts on this topic in the comments box below. Let's begin. The first way of calculating margin of safety is the way Ben Graham would do it, and that is by finding the difference between the earning power of the company and the returns offered by long-term risk-free bonds. So let's say a company trades at 100 rupees a share, and these are the company's earnings per share over the last 4 years. Now, one can clearly see the EPS is growing by about 15% every year, but since the margin of safety is a conservative principle, Ben Graham would prefer to average it out, which comes to 8 rupees 90 paisa per share. So this gives us an earnings yield of 8.9%. And with the long-term Government of India bonds trading at 7%, Graham gives us a margin of safety of 1.9%. Understandably, the greater this difference between earnings yield and bond yields at the time of purchase, the higher is the margin of safety. Now, for many of you, this concept might sound too basic, but remember in the 1930s and 40s, the idea of capital appreciation was practically unknown, and for many investors, including Graham, an investing decision was about when to put a money in a bond that pays a coupon versus investing in a stock that pays a dividend. Another way of looking at this concept, and I'm sure you've already caught on to it, is that a high earnings yield is just another way of saying a low price earning ratio. Which means essentially Graham is making a case for buying low PE stocks, which we now know is not a straightforward argument, as it's also important to differentiate between fundamentally sound companies that are available at low price earning multiples versus unsound and troubled companies that no one wants to touch with a 10-foot pole. Now, over the years, many investors have developed their own version of margin of safety. Some of them are quantitative, some are qualitative, some are based on thumb rules, some are exceptions, and some versions are a combination of everything. I shall be taking up 2 approaches that I explained in a wonderful post by Dr. Vijay Malik, and which offers a measurable assessment, a quantitative assessment to margin of safety. The first approach is what is called the self-sustainable growth rate model, or the SSGR model. Now, the word self-sustainable is the key here, and it means the company, the business, does not need to rely on any external source of funding like debt, and its current profit is more than enough to fund its growth. Another way of saying it is that the model uses the inherent features of a company, things like its net profit margin, dividend payout ratio, and the net fixed asset turnover to give us an indication of where this company is headed. So as a formula, the SSGR is the net fixed asset turnover multiplied by the net profit margin, which is again multiplied by 1 minus the dividend payout ratio, which is then subtracted by the depreciation. Okay, this might be sounding a little complicated, so let me break this down into more manageable fractions. So the net fixed asset turnover is nothing but the annual sales of the business divided by its average net fixed assets. What is average net fixed assets? It's the fixed assets of the business minus its accumulated depreciation, and we sum up the year opening and year closing values before dividing it by 2. Then we have the net profit margin, which is simply the net profits of the business divided by its sales, 1 minus DPR, or the dividend payout ratio, explains the percentage of profits that the business is retaining after paying dividends to the shareholders, which is also why it is called the retention ratio. It's an important number as it represents that portion of the profits that the business is reinvesting in the company's operations, and typically one would see that growing companies have a high retention ratio. And of course, depreciation is depreciation, which is the part of the profits that's kept aside and allows companies to write off an asset's value over a period of time. So that's the formula, and before we apply it on a couple of companies, let's also look at things beyond the formula to clearly understand what Dr. Malik is saying. So the NFAT, the net fixed asset turnover, defines the efficiency at which the business is operating, and understandably a high NFAT is good because it means the business is generating good revenues against every unit of asset utilized. The NPM, or the net profit margin, refers to the level of profitability, and the higher this number the better it is. And finally, a low dividend payout ratio means there is more growth funds available to the business, which is a sign of self-sustainability. In fact, Dr. Malik puts it well when he outlines the SSGR like a company's growth story. That is, the business sells products in the market, it generates profits from these sales, it then pays dividend from these profits, the company then reinvests the undistributed profits into improving or buying more assets, and these assets then produce even more sales in the future. Now, because the SSGR is a growth metric, our benchmarking, our comparison will be with the company's sales growth, which will help us understand if the business model has any inherent margin of safety in it. In fact, let's understand this entire thing with an example. So we look at 3M India Limited. Now, this is a company that needs no introduction, as most of us have already used their products. It's a company that has been present in India for many years and has enjoyed the fruits of an established brand and well-oiled operations. In the context of calculating its SSGR, 3M offers an exceedingly high NFAT, a moderate NPM, it does not pay a dividend, so the profits go back into the company, and it seems to be using a standard depreciation of 20%. Computing the numbers, this gives us an SSGR of 112%, which is a lot higher than the company's sales growth over the past few years. So essentially, this indicates that 3M India Limited's business model has the ability to generate cash in excess of its requirement, which can then help the company sustain its current growth rate without needing any external funding in the foreseeable future. Let's look at another example. How about Hindustan Unilever Limited? So HUL has a low NFAT, a mid to high NPM, a high dividend payout ratio, and a low depreciation rate, which gives us an SSGR of just 1.4%, which is a lot lower than HUL's sales growth, which is generally in the 10% range. The point Dr. Malik makes is that companies that have a higher SSGR as compared to their current sales growth do showcase a higher margin of safety. But remember, this margin of safety is not the margin of safety that Benjamin Graham was talking about. In fact, you'll notice that we have not used share price or market capitalization anywhere in the SSGR formula, which means this margin of safety has nothing to do with valuations. On the contrary, this concept we learned today is specific to the company's business model. That is, can the business run by itself, which, believe me, can be a massive advantage during times of recession or economic downturn. On the other hand, if the SSGR were to be less than the growth in sales, then it generally means the business has already maximized on its business potential, and further growth might require generating funds via debt, equity dilution, or a reduction in the dividend payouts. Understandably, Dr. Malik's suggestion is for investors to go after high SSGR companies, and as a concept, I thought this was something very new and refreshing to learn. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips, and stories that I continually post in the community section. A second way of gauging the margin of safety of a business, again, margin of safety of a business and not a stock, is to examine its free cash flow. Now, in my view, free cash flow is one of the most important determinants of a company's investability. And simply put, the term free cash flow represents the surplus cash that's left behind from the company's operations after it has provided for its capital expenditure needs. In fact, let me explain this with an example. So let's say you have a business, a textile business. Now, business is good, and say you are able to generate a profit of 10 crores from it. But what's also true is that the textile industry and consumer preferences are changing at a rapid pace, and therefore your company needs to upgrade its machines at least once a year. Now, a single upgrade costs you about 15 crores, for which you use your 10 crores in profits, and you also end up taking a loan of 5 crores. So from an accounting standpoint, you don't have much to worry. I mean, yes, there is a 20% depreciation charge for machinery and there is a 10% interest charge on the loan, but you still end up showing a profit. However, from a cash standpoint, you are at negative 5 crores right now, and the next year this would be even higher as you gear up for another 15 crore upgrade. So essentially you're putting in ever increasing sums of money just to maintain the same level of sales, which, when we draw a parallel to the SSGR concept, makes this business utterly non-sustainable. Now, I mentioned a textile company for a reason, and that's because this is what Warren Buffett went through with Berkshire Hathaway in the 1960s. And so instead of committing more cash towards a waning business, he opted to divert the money into buying stakes in other businesses like Geico, National Indemnity, etc. Okay, so as a formula, free cash flow is the cash from operations minus the capital expenditure. And while the cash from operations part is readily available in the company's cash flow statement, for CapEx, my preferred approach is to deduct the year opening net fixed assets and capital work in progress and adding back the depreciation. If this is too much work, then I should mention that some screener platforms do display a free cash flow number, although the formula that they use might be a little different from the one I'm proposing. Anyways, what we are looking for are companies where the free cash flow proportion of its cash flow from operations is on the higher side. So that would include companies like TCS, Infosys, Hindustan Unilever, ITC. So a lot of established IT services and FMCG companies which are big cash generators, and they generally don't have major capex requirements. And likewise, the companies you're not likely to find in this list would include Reliance Industries, Adani Enterprises, and definitely you won't find Avenue Supermarts in this list. The point is, companies that have a higher proportion of their cash flow from operations available as free cash flow offer a higher margin of safety. And as investors, our focus should be to identify these very companies that are and have been free cash generators for a long period of time, say a minimum of 5 years, which adds further proof on their capability and dependability. Alright, so we looked at 3 concepts in this video, and in an ideal scenario, we want companies that satisfy all 3 criteria. That is, a high earnings yield which is way higher than the yields offered by a 30-year Government of India bond, a high SSGR, that is a high self-sustainable growth rate, and a high free cash flow to cash flow from operations ratio. Now, generally, I would give you a list of companies in my videos, and I'm sure most of you are expecting this, but for this video, I won't do that, at least for now. Instead, I'd like you to open up whichever screening platform that you use and try to come up with your own list of 3 to 4 companies that satisfy these 3 criteria, and also what we have learned in previous videos. So for criteria 1, that is earnings yield, you're looking for companies where the inverse of the P ratio is at least 7%. Now, if you do this right, then for companies that have a market cap of over 500 crores, you should receive around 340 entries. Then for criteria 2, that is comparing the SSGR with the sales growth, you can use a formula like this, which brings down my list to just 18 entries. So there are going to be such trivialities, so feel free to modify some parts of the formula to suit your comfort. But just to put it down in a single page, this is what we are looking for on an unfiltered basis. Now, I'm sure if you've been watching other videos on my channel, you'll know I have limits as to how much of a screener I trust. And at some point of time, I prefer to walk away from a list and get into the hardcore understanding of the sector, business, growth engines, valuations, etc. But there is no denying that the concept of margin of safety is a truly important principle in investing. And the more you can imbibe it in the way you value a company, and now thanks to this video in the way you value the business model of a company, the greater will be your success rate in finding excellent companies that can turn out to be multi-baggers in the future. Once again, thank you for your time. A big thank you to Dr. Vijay Malik for sharing his knowledge. Please subscribe to my channel, kindly share this video, like this video, and I'll see you 3 days from now. Until then.